Hey everyone, Longacres Finance here. How does an 8% dividend yield sound to you? How about growing your investment at a 12% annualized rate of return over the long term? If this sounds like something you're interested in, stick around because the stock we are going to talk about today may be right for you. That stock is Ares Capital Corporation, one of the largest and best business development companies on the market. A business development company, or BDC, is an organization that invests in small and medium-sized companies. BDCs cater to growing small and mid-sized businesses that have outgrown their relationship with local banks, but that aren't yet large enough to work with giant financial institutions. BDCs issue their loans at market premiums and reward their investors by distributing profits in the form of dividends. A BDC can avoid paying corporate taxes to the government if they distribute 90% of their income to shareholders. This leads to most BDCs paying a pretty high dividend yield. Of course, not every BDC is created equal, and like any investment, there is risk associated with placing your hard-earned money in a BDC. Let's take a closer look at Ares Capital, and I'll let you decide for yourself if they are worthy for inclusion in your investing strategy. But before we get started, I'd appreciate if you'd give this video a thumbs up and subscribe to the channel for more weekly dividend videos. Ares primarily services middle market companies, usually with annual EBITDA between $10 million and $250 million. Their portfolio of loans are predominantly first and second lien senior secured loans, which account for about 79% of the portfolio. Senior secured loans generally have low default rates, which adds a level of safety to Ares' portfolio. Ares is the largest BDC in the United States, with about $16 billion of total assets. They are externally managed by Ares Management Corporation. The total portfolio is built of loans to 350 unique companies, with no more than 2% of the portfolio being allocated to a single company. The loans are spread around various industries, which minimizes the impact of economic cycles. During the pandemic crash of 2020, Ares' share price may have dipped significantly, but their loan portfolio proved to be resilient. Ares has a very strict process for evaluating new loans. They review hundreds of opportunities, but typically approve just 4% of the loans. An important metric to review for BDCs are the non-accrual loans. Ares did experience an uptick in non-accrual loans last year as a result of the pandemic, but that figure has already begun to shrink in 2021. Ares pays a very generous dividend. The company has managed to do so for 47 consecutive quarters. The company pays a 40-cent dividend right now, and based on its price at the timing of this recording, this results in an 8.02% dividend yield. The stock has historically paid between an 8% and a 10% dividend yield, so the current yield is one of the lowest you can get the stock for. But I think that dividend yield will go down in the future, and it's still very attractive at its current level. Last year, you could have picked up shares of Ares with a 20% dividend yield, but we can't dwell on the past, and as an investor, your objective should be to look to the future. However, I like to look at historical performance of a stock before I make an investment. Ares has traded publicly since November of 2004. Since that date, the stock has managed to grow at an annualized rate of 12.83% through May of 2021. The bulk of this return is derived from the dividend, but there is some capital share appreciation evident. It is always a welcome sign to see a high-yielding stock that also offers share appreciation, since not so many do. An investment back in 2004 would have multiplied more than 7 times in the last roughly 17 years, with dividend reinvestment. Not a bad multiple for this BDC. Starting with a $100 investment back in November of 2004, and adding $100 every month to Ares, would grow to about $83,000 today, and you'd be looking at a compounded annual growth rate of 50%. With dividend reinvestment, this would have produced over $6,000 in dividend income last year. That's over $500 per month, so 5 times the amount you would have been adding monthly at the same time. Reinvesting this passive cash flow is what is making this compounding machine churn. So far, everything looks very pretty for Ares. But no investment is free of risk, and I wouldn't be doing you any favors by skipping over the risks facing this stock. The most evident risk for Ares is interest rate risk. The bulk of Ares' portfolio is tied to floating interest rates, which are driven by market interest rates. Interest rates are near historic lows right now, so there isn't too much concern that rates will decline. Additionally, many of Ares' floating rates have investment rate floors, which will limit downside exposure. Another potential risk is that Ares invests in private businesses, which are inherently more risky than public businesses. This can also make certain loans less liquid. To finish up here, let's take a quick look at Ares' stock price and fair value. Based on dividend yield theory, Ares looks to be 20% overvalued right now. Their 4-year trailing dividend yield of 10.05% is significantly higher than its current dividend yield. However, the price decline in 2020, coupled with a 20% dividend yield, has driven the stock's trailing dividend yield to an all-time high. For this reason, dividend yield theory may not be the best model to use here, and I'll defer to Morningstar's fair value estimate instead. Morningstar thinks the stock is 10% undervalued right now, implying there is room for future price appreciation, and that the stock is still attractive at its current 8% dividend yield. That's it, guys. Thank you for watching, and see you next time.